Tom, thank you for coming on the pod.
Thank you for having me.
It's a pleasure to have you. Why don't we kick off with a quick intro, and then we'll get into Loqbox.
Yeah, absolutely. So, hello, thanks very much. I'm Tom. I'm Tom Eyre. I'm the CEO and co-founder of Loqbox, and we are, I think, one of the UK's largest financial wellbeing businesses, and we focus on building credit histories.
Nice. Well, tell me a bit about Loqbox in terms of the history
Sure.
of the company, where it started, how it started, and where you're at now.
Yeah. Okay. So, I mean, maybe I'll talk about why we started, right?
Sounds good.
Because that mission is largely unchanged over all the years. So, cast your mind back to 2008, 2009 ish, and I had just returned from working overseas. I was running a different financial services business, and my little sister left law school. We're all very proud, first one in the family, go to university, etc. And she got a job in the city, and she was kitting out her first post-student digs, and she wanted to get interest-free finance on a sofa from a well-known sofa retailer that is often offering interest-free credit, and she was rejected for that. So she went to our parents and said, "Mum, Dad, why?" And they went, "Well, I don't know. Go speak to your brother. He does something in money." So she came to me, and I said, "Don't worry about it, Lauren. You just thin file. You've got no credit history. Don't worry about it. It will solve itself over time." And I mean, I really chinned her off in this conversation. I did not help her at all. I gave her no guidance. But that conversation really haunted me. And the truth is that bear in mind, this is 2009, right? So we've had 2008. I am old enough that I turned 18 long before 2008. When I turned 18, I got loans of credit cards, should I say, literally landing on my doorstep. You know, back in the good old days of pre-approved for 15 grand, Tom, just go and spend on it, and that's you. That's you accepting the agreement. All of that was different. There was none of that anymore. And so Lauren's situation really got under my skin a little bit, and that led to me creating a business called Credit Improver, which was the first credit building product we've ever had in the UK. And that's the genesis of how we got to Loqbox. But actually in that story, the things that I think like beneath the surface of it that really matter, Lauren was systemically denied access to participating in the mainstream system. And at the time, there was no other alternative for her. So in order for her to get access to a product or service that we might consider relatively mainstream at a price that was appropriate, fair, reasonable, etc., well, I mean, she just couldn't do it. And the advice at the time is, frankly, still the same advice that many people still espouse today, which is to treat building a credit history as an outcome of using a service. So go get a credit card and spend a little bit on it every single month, pay it off, and at the end of the month, you'll have built a bit of credit history, and do that for long enough and you'll have built a credit score. But I mean, my God, it is perverse, right? It is perverse that the way we deal with this challenge, this problem that affects every single one of us, every single person that turns 18, every single person that arrives in the United Kingdom, every single person that wants to build a credit history, is to go and use the most expensive form of the most dangerous consumer finance product known to man. And particularly for those who are the most inexperienced in society or the most vulnerable in society. And their usage of the product largely subsidises the rest of our usage. Because, I have a credit card, I pay it off every single month, I get loads of points, it's great. Get purchase protection, it's awesome. Credit cards are amazing spending tools, they're terrible borrowing tools. And yet mine, as a potentially extremely capable user of a product, my usage of that product is directly subsidised by someone who is paying a fortune in fees, charges, late payment fees, etc., i.e. who is using the product in a way that it wasn't designed to use. There's almost nothing else in consumer finance, and almost nothing else in the UK at the moment, where the most capable in society are directly subsidised by the most vulnerable in society or the most inexperienced in society. And yet that's how we bring people into the credit system. So Lauren didn't have an opportunity to participate. She then went to go and speak to our parents. And Lauren is educated. She's gone to school, gone to college, gone to university, gone to law school. She's got a job. And it is disappointingly as true today in 2026 as it was in 2009, that we spit people out of schools, colleges, and universities into one of the most complex financial sectors on the planet. And we hope they will have acquired the skills to succeed by osmosis. And that's not the way it works. That's not how we learn about financial services. Not how we think about it. So that is still true. And then lastly, Lauren couldn't buy the sofa. I mean, no drama. She's just come out of university, but she had no savings, and that is a real problem that we have in the UK and actually in the West in general. An absence of savings. So in those three things, right, it's a long introduction to where Loqbox came from, but I think it talks to what we try and do today. It's about giving people an opportunity to participate in the system in a way that is fair, reasonable, transparent, clear, and without a lot of the risks associated with the traditional ways. It's about building people's financial education. If we are going to be, for many people, their first product that they use in the financial system, it's incumbent upon us to help people to understand how it works, how the whole system works. And then lastly, to try and encourage and help people to build savings, either to create the space to save, or if they already have the space to save, to actually start saving.
So essentially it's about the access to the credit system, education, and then that savings piece, right?
There you go. That's
Got you.
That's exactly what the business. That's exactly what the business does, and that really hasn't changed since 2009.
Okay, so that's stayed a constant throughout.
Yeah, if you look at our products now, our products are all, we consistently double down on those same three things: improve people's access, improve people's opportunities, improve people's savings, improve people's financial understanding and education. And everything we've built since then is to try and do those three things and hold them all in tension with each other.
And has the market changed? We cast back to 2009, but if we compare that to now?
I think we've gone through cycles. So if you go back to 2009, and indeed the years after that, you're talking about the years of kind of the upward trend in buy now, pay later. Sorry, not buy now, pay later, apologies. In short-term high-cost credit. That then disappeared. The FCA sort of largely, the FCA and the Financial Ombudsman Service largely got rid of that.
The Wonga type of
the
place,
Wonga type lending. And I suppose in its place, we have seen the rise of BNPL since then. Fundamentally, like, consumer attitudes towards credit has changed somewhat, particularly in younger generations.
In what way?
Well, younger generations today are using credit cards far less than they did previously. Now, some of that might be because of an increasing use of BNPL, which, in some instances can be a straight trade-off for credit cards. But also we know from research we've done that culturally, credit card debt and borrowing people are more wary of it today than perhaps they were in 2008, 2009, which maybe seems crazy coming off the global financial crisis, but that is kind of what we see and what I've seen. Other than that, I mean, I suppose in the industry, I guess there is also consumer duty, which I think is probably still far too nascent to say that it's had a material impact on the industry as a whole. It's pretty much the same as it was back then. Okay.
So then the products, you mentioned doubling down.
Yeah.
How have they changed? Focus on the same thing, but the actual way you deliver.
Yeah, we moved to, I think probably the biggest change from when we first launched the product is that we moved from a kind of membership subscription-based product in the early days to more of a savings-based single one-off proposition, and then we've moved back to a membership-based.
Okay.
So, we went on, we've all gone on cycles as we've gone through the last 15 years. But yeah, we've gone back to a membership model, which works really well, which gives us a lot longer to work with our customers and our users. Financial education has taken really big leaps and bounds, and we've done some really interesting stuff. I think we're just getting started in that space. It's particularly interesting what's going on there. We've made our products, I think, easier to use, which does not necessarily mean more engagement, less engagement. It just means easier to understand. I mean, ultimately, the financial system is complicated, and we are trying to do two things at once. We're trying to simplify it for people without missing the point that it is complicated. And when you leave us and go and access a mainstream credit card or a loan or a mortgage or something, you're going to have to use a more traditional product and be prepared for that.
Okay. And so Loqbox has been around for 15 years, you said? Or
well, no, Loqbox was 2017, founded Loqbox in 2017 out of credit improvement. It was the evolution of credit improvement.
Okay, so what if we're going sort of midway in the journey, I guess, what caused that catalyst to be like, right, Loqbox is its own thing in its own right?
Back, it was actually about the same time that we moved from a subscription model into a non-subscription model. As we were getting going with Credit Improver, we were a paid-for subscription service, super easy, X pounds per month you use the product. And we found that we weren't getting traction, so we actually built a savings-based product that allowed us to generate our revenue from the banks that we worked with, rather than from consumers. So we were able to build this like quite simple savings-based credit building product, where you as a consumer did not need to pay for it. We could get paid by the banks that we worked with. That coincided with me having the idea for Loqbox, which was a different type of mechanism, and it's probably far too boring to get into here, but it allowed us to do something slightly different to what Credit Improver did from a user perspective. So that was that move, and then from sort of 2017, 18, 19, 20 really grew the business. Then 2021 pivoted back into a membership model, which was just at that point an evolution of the product suite we were already providing to people. We realised that our members wanted more from us, and there's more we could offer outside of just a traditional 12-month relationship.
Okay, so that sort of, not pivot back, but the evolving nature of the business model came from you having more to offer and a larger consumer base, I guess.
Yeah, much larger consumer base. I mean, we grew massively during that period. I mean, we're still growing massively now, and just talking to our customers, it was really clear that there was a lot that we could do, and so we went and did it, built new things.
Nice. And what size is Loqbox now in terms of customers?
Yeah, we've served just over 1 million people in the UK. We had a bit of a stint in the US, pulled back from the US, and a focus on the UK predominantly for the last sort of 4 years, only on the UK market. And yes, it's over 1 million. It's a team of about 100 people based between Bristol, London, and the US.
I'd love to touch on the US and sort of what you learned from that experience. But in terms of scaling, from nothing to 100 employees, over 1 million customers, you said. What have you learned about building company culture, the type of people that thrive at Loqbox, these sorts of human-based parts of building a business?
Well, I mean, it's tricky, right? It's always tricky. It's not smooth sailing by any stretch of the imagination. I think we have seen, probably like many, I think we have seen the different seasons of Loqbox as we have grown, and with each season comes often a sort of people that really thrive in the sort of business that we are. So we are a mission-driven business. We have a mission. It's right at the heart of what we do. It's something we believe in really strongly, and I think we get a lot of people that join us who are culturally attracted to that mission. And then we have the size and scale of the business and what that calls for. And being a 5-person organisation with 10,000 customers is wildly different to being a 120, our largest, 120, 130 person organisation. And the tools that we use, the processes that we develop, the way that you interact with your colleagues, COVID thrown in for good measure in the middle of that. Yeah, culturally, it's been a wild ride. In terms of people that thrive, I think self-starters, creative, divergent thinkers. These are people that I think I see do really, really well at Loqbox. Why? Because we are doing everything brand new. There is nobody on the planet that has built a financial wellbeing business based in the UK in 2026. Right, like every single challenge we face is brand new, and even if it is just marginally different to challenges that other people have experienced before, the particular flavour of how we approach it, the same as would be true for anyone, makes it a unique proposition and a unique challenge. So people that come in and can self-start, can think divergently, can problem solve, really, really get on very well.
Okay. And how intentful have you been about hiring those people from the get-go? Was it been that kind of came as you saw what worked, maybe what didn't?
I think it's probably only been the last 5 or 6 years that we've been really intentional about trying to create that culture. Before that, it happened by accident, and nothing happens by accident, right? Like when we were hiring much more on just vibes alone, when I was involved in all the hiring decisions, it's only not been that long that I haven't been involved in all the hiring decisions. We were creating that golden thread between everyone by having that almost culture check in the onboarding process. that was happening by accident. It wasn't something that I think we were intentional about doing. But as we've grown, we've got an amazing people and operations director. She has got an awesome team around us. She's really helped us to put in place the processes and flows that make sure that we create not just a really great environment for everyone, but that we bring people in that add to the collective good of that environment, rather than have people in that are the wrong size, scale, fit for us as an organisation.
And how has your role as founder, as CEO, changed as you've scaled?
Well, I mean, loads, right? And I mean, I'm sure that, and everyone that answers this question says something along the same lines, right? Which is, in the early days, it was just do everything. It was me and my co-founder, and we just carved the jobs up. I don't think as a business we do a huge amount more today than we did previously. We do it at much larger scales. So pretty much every job in the business was done by one or the other of us, which means you have to be a jack of all trades. And we did that. We did that really well, and I really enjoyed that. What I do now is totally different to back then. I don't think the business would survive if I was still doing that same role. As in, I think I would probably be at risk of crashing it into the ground for doing too much stuff and exploring too many things in one go. I'm not very good at process.
Okay, you're like Donny, my co-founder, then.
Yeah, he's sat out there watching. Yeah, I don't love process, and I'm really, really, really comfortable working on gut feel. Now, these can be great characteristics. These can be great traits in the right places. They are not they're not brilliant when you are creating process, particularly in financial services, in consumer finance, in regulated environments. We really need to make sure that we have all of those processes in place, and I think our teams have done that really, really well over the years. So now I spend much more time talking about the mission, about the purpose of the business, and probably less on product and proposition.
Okay. And did your co-founder help balance that gut instinct with process, or were you both very gut instinct focused?
Yeah, I suppose he did, actually. Yeah, he did. We had overlapping skill sets, but they were not overlapping by that much, which is great. So we had a really broad spread of skills, and we had a really closely aligned view on mission and purpose and why we were here, and where I may have been, where I may have needed tempering in some places. He was able to bring that, and similarly, where areas that needed a little bit of a jolt, I was able to try and bring that slightly divergent thinking to those conversations. And much of what we have done at Loqbox is innovative, right? It's brand new. We were the first credit building product in the UK. We continue to be at the forefront of that market, and largely, I think that is down to the innovation within our business, which is something you can kill really easily. It takes time, effort, and energy to foster organisational kind of divergent thinking without it going a little bit wild.
I mean, you've touched on the innovation side, mentioned consumer duty and operating in a regulated space. So what have you learned about building a startup in a heavily regulated sector when it comes to regulation?
Yeah. I mean, we could probably talk for hours on that particular subject. Get really good advisors. I would say get really good advisors, and then challenge your advisors. You don't want to be challenging someone who isn't an absolute expert in their field, but do challenge them. I mean, I think certainly what we found at probably the more innovative side of the space, and certainly working in an area where I think over the time I've been doing this, the area of the market we've worked in the UK is it's been really challenging. And it's growing, and these are not good. These are not good things, right? Like the number of people that are underserved by the mainstream financial system today is significantly larger than it was 5, 6, 7, 8 years ago. I mean, that is a real problem for UK PLC, that so many people are underserved by the financial system. Some of that is down to a lack of innovation. Some of that is down to regulatory hangovers. And some of it's down to the fact that actually it can be quite unattractive to play in this particular space. But I think that actually, if you're coming into this and, so what have I learned? And I said, pick really great advisors, then challenge your advisors as much as you possibly can. that I think is a really great recipe for finding innovative edges and finding ways to do things that maybe haven't been done before or previously felt too challenging, too difficult, or dare I say it, in some instances impossible, that actually really should have been recategorized as improbable, and then until someone goes and does it.
Okay. And do you think, you mentioned compared to 5 or 6 years ago, there's more underserved people in the UK in the financial services sector? Is that due to regulation? Is that just due to culturally things aren't like, what's caused that?
It's a lot of things, right? So there's no singular smoking gun. I mean, for starters, you've got to look at the macroeconomic conditions, right? It's fucking tough out there, right? It's tough out there for everybody. So we have hard times. We've come off the back of COVID. We have a cost of living crisis. We have a real, I think, countrywide challenge with the future and positivity, possibly a lack of positivity, kind of everywhere. We've had, from a regulatory perspective, we've had consumer duty, which on the surface is great, right? But we are a long way away from seeing that delivered and how that's actually going to work. We have a regulator that is, I think, doing the very best possible job that it can do, but it's under-resourced, I think. I don't think anyone would be too upset with me saying that the regulator seems under-resourced.
Just on that, it's interesting because I think sometimes regulators seen as bloated. It's too much has gone into the regulation.
Well, I mean, possibly too much of the wrong thing has gone into regulation. But I see some incredible work by the FCA at the moment, and I know the board of the FCA is really trying to grasp growth, which is what the government and the country is demanding from a regulation. They're in a bloody difficult position, right? You get it wrong and you get beaten up. You get it right and you probably get beaten up for not doing it right beforehand.
Or no one cared. It wasn't you that caused the right.
It's really difficult. So I don't think they have an easy job by any stretch of the imagination. I think they're trying to do the right thing. If you look at the innovation pathways and the likes of Colin Payne at the FCA, just doing incredible things in that respect. But there is also a legacy and a hangover from stuff that's happened previously that ultimately makes it very unappealing. I mean, why would you build a business in what the regulator might term the subprime or the near prime space? Well, you might be mission driven like us. You might genuinely feel that there is a mission to be done to try and include people in the financial system, that makes individuals, families, societies, communities better when you do that. Or you might be a business, but either way, you've probably got someone funding you. And that funding is probably institutional in some way, shape or form, whether it's an angel round or whether it's a loan, etc. We have a lot of, over the last sort of 10 years, we have a lot of regulatory hangover. I started working in this space in the OFT days, and then we had interim permission, then we had the FCA. The FCA got rid of a lot of the industry. The FOS did a good job of getting rid of a whole load of other parts of industry. It wasn't very transparent how that was happening. It was quite difficult to understand why that was happening. Some of it was done by the back door. It didn't involve legislative change. All of this is difficult, and all of that creates uncertainty, and uncertainty is not what anyone funding a business wants. So, I've definitely spoken to funders who've just said, I just won't play in that space in the UK. I will, not about us, but about, pals, group founder therapy sessions. Who've said, we won't play in that space because it's just too complicated, or we don't trust that the FOS isn't going to make a different decision one day and then retrospectively apply it to a whole lot of stuff that's happened over the last 10 years. That is problematic, right? That does not encourage innovation in that particular space. And that's why I think what the FCA is doing today is so good, because they are coming out and trying to combat that headache, that hangover, and say, this is what's happened in the past, but this is our stance now, and this is what we have moving forward. Now, as long as they follow through on that, I think that we will continue to see a wave of innovation in this space, which I hope will be the groundswell that starts to change the financial inclusion story in the United Kingdom. If they don't get that right, then it's all a waste of time, and we won't get any kind of material or meaningful change in that part of the industry, because money will go somewhere else, and why wouldn't it? We're a largely globalized economy. People can invest wherever they like.
I mean, talking about the globalized economy, I did say I'd come back to it. The US, what did you learn? Why maybe didn't it work in terms of staying out there? Was it a strategic to come back?
Yeah, I mean, look, it was a whole load of things. I'm really happy to be super open about about where it went well, where it went badly. For starters, we launched into the US on the 1st of January 2020. This is a terrible, terrible day to launch anything overseas, particularly where we were trying to do it relatively under-resourced. We were having to travel a lot because COVID really screwed us on that. But actually, what was within our control when everything opened back up again, some of the fundamental hypotheses that we'd had going in, we did not re-examine there and then, and we absolutely should have done. We waited. We are an ecosystem-led business, so we work on both sides of the market. So we have consumers, but often the way we acquire consumers is through partners who are finding people who are financially excluded from the system as an almost byproduct of their day-to-day activity. Well, that in the UK, people totally understand that we have an incredible ecosystem in the United Kingdom of consumer finance providers who genuinely care about consumers. I'm not going to categorize all of America as the same, but we definitely did not find that the same over there. The presence of an awful lot of VC money changed the market dynamics in a way that we didn't want to play in, right? It wasn't a merry-go-round we wanted to get on. So we were not prepared to buy a customer for $5 that we knew we would only ever make $1 out of. That just wasn't our mindset. But on the platforms, we were being out-competed by payday lenders, and we were going to the businesses and saying, look, we have a way better product for some of these customers. You would be better trying to split those customers out. The ones who are better suited for us, send them to us. The ones who are better suited for payday lenders, send them there. But that was a level of sophistication that they weren't prepared to do because we were willing to pay X and our competitors were willing to pay Y. Therefore, it didn't matter to them whether it was the best product or the right product for them. They were just willing to pay. So ultimately, we didn't move fast enough on that. And when we really sat down to analyze it, the context switching we were asking our team to do between two different, really quite complicated, and we were operating in 47 states in the United States. So this is a lot of complexity, in a system that at the time I reckon was probably still writing more paper checks than it was sending instant bank-to-bank payments. It just didn't work for us. So we made the call, and probably one of the best calls we've actually made to come back and focus. It doesn't mean we won't go back to the US. I definitely think it's on the horizon. I definitely think, actually, embarrassingly, probably from a product perspective, we probably had the strongest product in the market, but for a whole host of other reasons that we couldn't overcome, we didn't have the patience or the capital to get there.
Sounds more like a market and timing kind of issue rather than product or problem fit solution. Okay. I'm conscious of time. We've managed to get through everything in a lot in 30 minutes, but there's one thing I did want to ask you, which was, if you were a fintech founder just starting out in the UK, are there any practical piece of advice you would offer which they could take in the first year to 2 years of their founding journey and beyond?
Do you know, I don't think this is probably specific to fintech. I'm so sorry about that. But I think get a really good coach, or get some coaches around you, get some people that have been there and done it. I definitely have really leaned on some of the advisors that we've had, and they've helped us stay away from some really bad decisions and helped us get into some really good decisions. I wouldn't rush to set a board up at that particular stage. I think in the early days, don't bother, focus more on product market fit, but even if it's just an informal kind of individual or group of individuals that can provide you some guidance. Treat cybersecurity really, really seriously, because until it goes wrong, it doesn't feel like a big deal, and then when it goes wrong, it really, really, really fucking hurts. Get good advisors from the regulatory space, definitely if you're in the fintech space, and challenge as much as you can, because we've done, like I said, we individually have done a whole load of stuff that I was told in the early days by one set of advisors was utterly impossible, and yet we have done it, and it's been, by our standards, wildly successful.
Those edges, those innovative edges.
Yeah.
Okay.
Yeah.
Tom, thank you so much for coming on.
Thank you. Yeah, very nice to be here. Thanks very much.